The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Live from Studio 2 at Bloomberg headquarters in New York, I'm Katie Greifeld.
And I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S. Let's get a check on where things stand here on this Thursday afternoon. Oh, my foot is coming out of my shoe, but I fixed it there. Okay, so the S&P 500 down 0.5%. The equity rally showing signs of slowing down. This is the second decline in 3 days. We are seeing yields higher across the curve. The 10-year now at 4.14%. There was a $22 billion auction of 30-year bonds. Demand was mediocre and dealers had very little interest in the issue. Another big theme that's starting to emerge is the resurgence of the dollar, or at least a bit of dollar strength. The U.S. dollar is higher versus all 16 major currencies, and you can see against the yen, we're talking about a 153 handle. And silver, now lower, but it did surpass $50 an ounce today, so a lot of people talking about a switch from gold into silver, Katie.
The devil's metal, we'll get into all of that and more. And the market overall certainly getting a heat check today as concerns over a potential AI bubble continue to grow. Piper Sandler's chief market technician noting that market breadth is showing early signs of fatigue as traders shift their attention towards the upcoming earnings season, which, if Delta and Pepsi are any indication, it could be another blockbuster quarter. The airline's third quarter results came in better than expected, but the real star was guidance. Delta saying it has full confidence in the travel consumer and sees robust demand going into 2026. Meanwhile, PepsiCo, for its part, also issued a positive profit outlook for the year, with the snack business saying it's prioritizing cutting costs and overhauling its portfolio to meet consumers' shifting tastes. The other star of the session, as Scarlett mentioned, it's silver, not gold. Gold, it's come back down under the $4,000 level. You have spot silver in the spotlight as a result, jumping to its highest level since the 1980s due to surging demand for those safe haven assets. Silver has been quietly having quite the rally, rising 70% this year and actually beating gold's record-breaking rally. So something is going on with these metals, Scarlett.
Absolutely, because when you talk about gold, Ken Griffin of Citadel is concerned that investors are actively seeking assets that they believe are safer than the U.S. dollar. So here's a look at the debasement trade through Katie's and my favorite products, which are ETFs. The biggest gold fund, which is GLD, of course, in yellow, appropriately enough, saw assets rise almost 80% to $131 billion. That's compared with the white line, which is the two biggest Bitcoin ETFs combined. And together, their assets are up 272% to $125 billion. Bumping along the bottom of the chart here is TLT, the largest long-duration treasury ETF. Its assets dropped 16% to just under $50 billion. Ken Griffin says investors are looking for ways to effectively de-dollarize or de-risk their portfolios as excessive stimulus stokes markets and drives an economic sugar high. Katie?
Well, let's kick things off right there with Alex Petrone. She is head of fixed income over at Rockefeller Asset Management. Great to see you in person, Alex.
Good to see you.
So it is interesting when you think about how the different asset classes are talking to each other. Perfect chart over there by Scarlett, talking about how you see this push into maybe alternative sources of havens. But then you consider treasuries. You're not seeing that same haven bid.
I think not yet, not today. We've had an economic backdrop that, generally speaking, has still shown signs of growth. There's weakening in the labor market, but some who view it as possibly a rotation. There is productivity gains that people anticipate coming out of AI and other spots. So I think it leaves us in this sentiment of, do I want to own certain spots of the yield curve? And that's why you're seeing maybe the comments around the 30-year auction, more tepid demand. That's not to say that investors don't own fixed income. You're seeing flows coming into bond funds today, whether it's high-grade taxable or high-grade tax exempt. So I think it's really kind of looking at where investors are allocating assets as that hedge, but also being mindful of the risks that we continue to see.
Well, let's talk a little bit more about where you're picking and choosing when it comes to the yield curve, because that steepening, of course, it's been pretty consistent over the past year or so. But where do you think is most attractive and feels the safest right now when you take a look at the curve in its totality?
So there's a few spots, and a lot of our investors look to us for some type of, we'll say, relative stability, but also best relative value. We land in the same spot that I feel like we talk about over and over: high quality and opportunistic municipals. For U.S. tax-paying investors, you're able to look at an incredibly steep yield curve, nearly 200 basis points of slope between 2 and 30 years. You're also looking at an asset class that has a materially different duration profile than 30-year treasuries. So you can look at a space where there's been underperformance on some weakness related primarily to technicals. We've started to catch up versus the last discussions we had when I was here, because demand is present, supply is still heavy, but the long end of the municipal yield curve is quite attractive right now for U.S. tax-paying investors, and we believe that that is an area that will continue to be a safe haven as well, and a good hedge. Sorry, Scarlett.
No. You mentioned technicals, and I'm mindful of the fact that technicals play a pretty big role in the muni market. Are there any seasonal technicals that we need to be aware of then?
Yeah, absolutely. So seasonal technicals do tend to come into play as you get into the November, December type of time frame. And so what we typically have seen is that calendar dries up. That's not always the case. So when we think about the technicals within the municipal market thus far this year, we have had record issuance. Right? We continue to see supply pick higher. Now, we anticipate that supply can stay elevated for the next couple of years. What we start to look at are muni to treasury ratios at different points in time. And what we've seen is in that period from June, July, August, usually the technicals tend to get quite strong heading into August. That wasn't the case this time around. So it's important to look at technicals. It's also really important to look at absolute values. It's important to think of this allocation as part of your hedge, because I think what I heard earlier were comments around fatigue in equity markets, comments around an AI bubble. And so it is important to have that hedge even today.
What about the government shutdown? Now in its 9th day, how does that impact municipalities and the issuance of debt?
I think in the near term, no real impact. If you look at municipalities, by and large, 40,000 active issuers. This is the moment where it's critically important that you do that bottom-up analysis that we're doing and think through who is heavily reliant on federal transfers as a key part of the revenue source to pay debt service. By and large, that's not the case. What we anticipate is the longer this shutdown continues, you have to worry about kind of two key things. Some of those federal transfers for major infrastructure and projects, such as mass transit, and any more delays that can delay growth on top of it. So we're keeping a close eye, but I go back to technicals will continue to be the key factor. Is there demand for muni risk right now? And we're seeing it pick up materially. And then on top of that, does the supply dynamic remain relatively consistent and manageable? And right now that's the case. So we could head into the tail end of this year and see that technical backdrop continue to improve.
Well, when it comes to the shutdown, the effect that it's having on the muni market, beyond supply and issuance factors there, what about the human aspect of it? When you think about the impact that it could be having on sentiment, you take a look at the equity market. By and large, it doesn't seem too bothered. Sure. Is it a similar story when it comes to munis?
I think thus far you have seen rates, the anticipation of the Fed, the supply-demand dynamics being kind of the key factors that are driving performance from here. I think in the near term, it's not going to impact how investors are looking at the market.
I know you're looking at municipal bonds through a bottoms-up perspective, examining each one, but are there certain states that look more attractive at this point than others?
Yeah, I mean, when you look at some of the high growth states, if you think about California, look at New York, look at Texas, Florida, where you have, generally speaking, finances that are in order. Overall, in the post-GFC world, great financial crisis, we have seen states really get their fiscal house in order. We've seen across many sectors the same thing. You still have to be mindful one by one and look not just at state finances, but down to each individual sector, each individual obligor. I mean, we have a market that has 40,000 active issuers. One of the most diverse markets out there. It keeps us able to find inefficiencies and a lot of opportunities.
Yeah, you need a sharp pencil to navigate those markets. Alex, great to get some time with you. That is Alex Petrone. She is head of fixed income over at Rockefeller Asset Management. Now, coming up on the close, former U.S. Comptroller of the currency, Gene Ludwig, warns that Washington's data isn't just delayed, it might be outdated. A conversation on what the implications could be for the financial markets.
From outdated stats to out-of-the-box investment strategies, we discuss the opportunities in the private markets with David Layton. He is CEO of Partners Group.
And as the markets find their next scene, Imax CEO Rich Gelfond zooms in on what's keeping audiences and investors tuned into Hollywood. All that and more coming up. This is The Close on Bloomberg.
Delta Airlines shares jumping on a strong 2026 forecast by the airline, helped by leisure passengers springing for premium offerings and a bounce back in corporate travel. So joining us now is Siddharth Phillip. He is Bloomberg's chief aviation and transport correspondent. So Sid, when we talk about Delta, what I remember most is earlier this year when Delta warned of this abrupt slowdown that took everyone by surprise. It feels like we are past that completely now.
We are seeing a sort of rebound in demand. We're seeing a rebound in sentiment. I mean, remember that there is this sort of dichotomy between airline customers where the top end of the market continues to grow. People are continuing to choose premium options for travel, and leisure travel is still big. At the bottom end of the market, the discount carriers, the ultra low-cost carriers, they're still struggling to fill up those seats. So there is this dichotomy, and Delta Airlines, with their strong sort of offering of premium seats and their sort of increasing push to have more capacity that's premium, is sort of really cashing in on that trend.
So with that in mind, that there is this dichotomy when you take a look at, who is flying right now, what can you say about how some of the other airlines should fare here? When you think about who is closely aligned with who is flying on Delta, what does that mean for the likes of American or United?
So United, again, like Delta, has been sort of premiumizing their fleet, and they're premiumizing their sort of offerings, and they're offering more business class seats, more premium economy seats, and that's really good for business. At the same time, we've seen the likes of Spirit Airlines, which is in its second bankruptcy, and others that are sort of struggling and having to sort of compete on price and sort of compete for the consumer by offering discounts and sort of any sort of low fares that they can. And even Delta sort of pointed out to the fact that they were struggling at some point to fill up their main cabin, their main economy cabin, although the airline has said that sequentially they're doing better on filling up those main cabin seats.
Okay, I want to get back to that premium idea because Delta has really led the way on that. Can you tell us a little bit about how much it's changed its offerings, whether it's the cabin and the configuration of its airplanes to account for this premium customer?
So both United and Delta have been adding more premium seats into their aircraft. They're also sort of doing more credit card tie-ins and sort of offering more both on the ground and in the air benefits to their customers. And that sort of, the airlines have talked about how that makes customers more sticky and sort of more eager to book with them rather than use price comparison websites and other sort of offerings to see what the lowest fares are. Instead, because when you're tied in with the credit cards and when you're tied in with the lounges, you sort of tend to choose the same offering again and again.
And let's put this conversation in context of the ongoing government shutdown. As Scarlett said earlier, we're in day 9. We know that it's starting to cause issues for, of course, some of the airports. We heard from the Transportation Secretary earlier today, Sean Duffy, saying that basically the air traffic controllers who are calling in sick won't be paid. I mean, did that come up on the earnings call, the fact that you do have this big overhang right now? So
there has come up on the earnings call, and Delta Airlines said that they haven't yet seen an impact, but there is a risk to the system because we are seeing delays in airports, including Dallas, including Chicago, and others, where there is more and more delays because of air traffic controllers not showing up, and that's really causing causing concern that this might become more pronounced and that might have an impact on airlines and may force them to cancel or delay flights.
All right, Sid, really appreciate your reporting. That is Sid Phillip. He is Bloomberg's chief aviation and transport correspondent. And that's the thing, Scarlett. I mean, we talk maybe sometimes glibly about how the market is just whistling past this shutdown. But in terms of people's lived experiences, it's certainly starting to show up.
People's livelihoods, right? I mean, I don't know about you. I'm pretty sure everyone would be in this camp. I would like my air traffic controllers paid and happy and, willing to be doing the job and excited to be there, as opposed to, having to call out sick because they couldn't hire a babysitter to watch their kids.
Yeah, absolutely. It's certainly a pressing issue, and it's going to be fascinating to see how that develops. But coming up, we're going to keep talking about earnings because PepsiCo popping. We'll parse through that report with an analyst who covers the stock next. This is The Close on Bloomberg.
All right, some breaking news here on Microsoft, whose shares have fallen to session lows after Bloomberg wrote a headline saying Microsoft forecasts show that data center crunch persists into 2026. This is longer than what the company had anticipated. The CFO in July had said that constraints would continue through the end of 2025, but it looks like this data center crunch will now go on for longer. They're experiencing shortages of physical space or servers, according to people familiar with the matter, and new subscriptions for Azure cloud services are restricted in some crucial areas, including Northern Virginia and Texas. Katie?
All right, we'll keep an eye on that one. Shares moving lower right now, but it's time now for our top calls. A look at some of the big movers on the back of analyst recommendations. And we start with Oklo. Canaccord initiating coverage of the nuclear technology company with a buy rating and a street high price target of $175. The firm sees nuclear energy demand growing and believes that this company will become an energy leader. Shares up marginally. Up next, Roblox. MoffettNathanson saying it's game on as they upgrade the video game maker to neutral from sell and boost their price target to $91 from $63. The analyst says that user metrics have exploded higher and eye-popping user growth could propel the stock further. Not exactly eye-popping right now, up about 0.5%. And finally, we have DraftKings. Berenberg betting big on the sports betting firm as they up their recommendation to buy and set a price target of $43. Despite, quote, threat of disruption from prediction markets, the analyst is confident that the sell-off is overdone and that DraftKings has continued to deliver solid levels of growth. Shares marginally higher, up about 3%. That's not bad. Those are some of our top calls. Anyway, another stock we're taking note of is PepsiCo. Shares much higher, about 3.7% after the company reported third quarter results. Joining us now to discuss, I'm pleased to say, we have Filippo Falorni. He is Director of Equity Research over at Citi. He has a buy rating on the stock. Great to have you with us because you take a look at some of the details here, Filippo. I think a lot of folks were surprised to see that they're urgently overhauling their portfolio right now. They're working to cut costs and also think about their brands. We know that there's an activist involved as well. What's your reaction as you think about some of the details that we learned?
Yeah, absolutely. Hi, Katie. Thanks for having me on. Look, I think the quarter was definitely better than feared. There were some concern, especially on the snacking side. Results were not great. They were down 3% in the snacking. But overall, the company still grew organic sales 1.3%. And to your point, they talked a lot about changing their portfolio. There's a lot of focus on innovation, especially in the protein side. Protein is being one of the areas that is growing the fastest within the food and beverage industry. And Pepsi announced a lot of launches in the protein space, both in the snacking with more protein option within their potato chips offering, but also in beverages where they launched 3 new platforms within the protein kind of area. Muscle Milk is a full relaunch of that brand. Then they launched a new product with Starbucks ready-to-drink coffee. And then finally, Propel. It's a new product that is like a powder, essentially to provide the consumer protein as well as hydration. So really a lot of focus on portfolio transformation that can get people more excited about the long-term growth potential here.
Well, you went exactly where I wanted to go, and that's, of course, this discussion on protein, because it seems like protein is everywhere right now. You mentioned Starbucks, of course, rolling out their protein cold foam and their protein lattes. I have tried both, but it was interesting to take a look at some of the commentary on the call saying that, actually, I think fiber will be the next protein. We heard that from the C-suite of Pepsi. I mean, how difficult is it to sort of keep up and keep track of these shifting consumer trends and then actually translate it into products?
Yeah, no, that's a good question. I mean, look, I think the reason why Pepsi is trying to find the next trend is because the protein surprised not just Pepsi, but I would say most of the food and beverage companies that I cover. And so now they're trying to find the next trend, right? Because for now, they're really trying to play catch up because their core salty snack business and the core beverage business is facing pressure from consumer changing their preferences in terms of both meals replacement and beverage options. So now the next leg, according to Ramon Laguarta, Pepsi CEO, is really the fiber. So they're also trying to focus in the area. Remember, they also have a Quaker food business that plays in the fiber trend. They're trying to also revamp that part of the portfolio. So really, again, to your point, it's really try to find the next trend at the consumer level.
What does this focus on protein and the shift to really start focusing on fiber mean for pricing of its products and therefore margins?
Yeah, no, that's a good question. I mean, look, margins, there's definitely going to be some pressure as you have to reformulate products, you have to launch new innovation, and obviously spend behind innovation. Usually marketing and advertising goes up quite a bit as you have a new innovation to support. But look, ultimately, long term, this is favorable for the company because you're getting, to your point, into higher price points. And so ultimately, when you pass through the period of launch, ultimately could be better for their margin profile. So I think overall, the market is definitely seeing some green shoots. Again, it's still a little bit early to see results, but I think Pepsi is moving in the right direction on that front.
I think you bring up a good point, which is all of that shift requires more innovation and therefore a lot of work behind the scenes, which would mean higher expenses as well. How patient do you think Elliott Investment Management is willing to be with perhaps increased costs to launch a new focus on fiber, for instance, to get the returns that Pepsi is looking for?
Yeah, no, Elliott, look, is taking a pretty big stake in Pepsi here. They're obviously an activist investor, so they're really pushing for change. And I think the important thing at Pepsi is that while they're doing this transformation, they're also focusing on productivity and cost savings to offset a lot of those costs and expenses, right? So the goal is to improve the top line, but at the same time, really focus on cutting costs in a way that you don't go backwards on margins, right? And so I think that's going to be the focus. And obviously, there's obviously a bit of a kind of a tension between top line and margins. But I think Pepsi is really focused on doing both at the same time.
And we have less than a minute left with you, but I see that you also cover Coca-Cola. You have a buy rating on that stock. They don't report until the 21st, but is there anything you can glean from what we learned from Pepsi and apply it over to Coke as well?
Yeah, no, absolutely. Pepsi definitely talked about the international results being a little bit softer in Q3, but also seeing a pretty solid acceleration into September. And so I think for Coke, look, there's definitely been some concern around some consumers in international markets. Remember, Coca-Cola is much more of a global company. 40% of their sales are from emerging markets. And so there might be some temporary pressure in Q3, but the important thing is that the exit rate into September sounded pretty solid from the Pepsi results.
Filippo, fantastic to get your perspective. Filippo Falorni is Director of Equity Research over at Citi, talking to us about PepsiCo, whose shares are rising today. Now, coming up, a conversation with Gene Ludwig. He's the former U.S. Comptroller of the currency, to discuss his new book, The Mismeasurement of America. We'll talk more about that and the impact of the government shutdown. This is The Close on Bloomberg.
Just about 3:30 p.m. in New York. This is the Countdown to Close. I'm Katie Greifeld.
And I'm Scarlett Fu. And some breaking news here. The U.S. agreeing on an Argentina $20 billion swap line where it would help buy pesos. This framework basically allows for that and help support that country's currency, because this has kind of been an ongoing story that has been very disruptive.
Absolutely. Certainly in the financial markets. We're hearing from Treasury Secretary Scott Bessent saying that the U.S. Treasury is prepared immediately to take whatever exceptional measures are warranted to provide stability to markets. So the U.S. stepping in a big way here.
Yeah, the U.S. Treasury directly purchasing Argentinian pesos as part of its support for the country. This is a step that U.S. authorities really had rarely taken in recent decades. So with this U.S. intervention, let's bring in now the former U.S. Comptroller of the currency. Joining us now to discuss is Gene Ludwig. Gene is also the author of the newly released The Mismeasurement of America: How Outdated Government Statistics Mask the Economic Struggle of Everyday Americans. Gene, it's good to get you here with us, and how fortuitous that we have you here on the day that this swap line is announced. Can you give us your instant analysis on why this is significant for the U.S. and how this helps kind of restore financial stability across North America?
This is one of the toughest calls that a Treasury has to make, which is currency support. And happily, the United States is blessed with a very fine Treasury Department with a lot of experts Keeping international stability in these currencies is important. They don't take these things lightly. I'm sure they've thought about this from every conceivable angle. And net, I think it's a good thing to do, but it's a very tricky thing to get right. And they're smart to try to get ahead of it.
Let me ask a dumb question, because you have Scott Bessent, the Treasury Secretary, saying that the U.S. Treasury is prepared immediately to take whatever exceptional measures are warranted to provide stability to markets. Some people might wonder, what is it about Argentina that the U.S. has such an invested stake in? Why is the U.S. so particularly focused on this country when it doesn't seem to have much impact on people's day-to-day lives or the U.S. economy on a day-to-day basis?
Well, you know, it's an important country. It's much larger and richer than most people understand. So making sure that this stays stable, as well as the currency markets generally, is a sensible move. But as I say, this is a very hard area. In my day and age, we were worried about Mexico, and we took some extraordinary measures at that time that worked out. But we've got competent people doing this, and getting ahead of it and showing strength is a good thing.
Well, that's the thing, Gene. This is a tricky area to intervene in. You think about the currency markets, there's no guarantee that intervention will have the intended effect, that it will actually be able to stabilize the exchange rate. When you look past at your tenure, I mean, what does it typically result in? Can you be confident that the U.S. will get the intended effect when it comes to Argentina?
Katie, these are enormous markets. And as powerful as the U.S. is, and as well-meaning as the U.S. is, it's one of the reasons this call is so hard. Getting ahead of it, showing strength is a good thing, but it's a roll of the dice. There's no doubt about it.
Yeah, it'll be fascinating to see how this evolves with those fickle foreign exchange markets. But I do want to move on. I want to talk more about the U.S. because, as Scarlett mentioned, of course, you have a new book out, The Mismeasurement of America, How Outdated Government Statistics Mask the Economic Struggle of Everyday Americans. And I think that's really interesting because prior to the government shutdown, now we aren't getting any U.S. official data from the government, but there was a big question about the quality of U.S. data, especially when you think about the big revisions that we were seeing to the NFP results and the like. And I wonder how you think about that, the quality of U.S. data and whether or not it has eroded over the past several years.
Well, Katie, this is an enormously important subject, and I'm glad you've raised it. Data for the general public, for our policy leaders, and how that's explained is really enormously important, because if you're going to shoot at a target, you're going to make things better, and everybody tries to do that, you better know where the target is and try to hit the bullseye. The problem I've found with the government data is not the data collection itself. They're good-hearted people collecting things accurately. It changes from time to time as new data comes in. But it's actually the definitions they're using that are really long dated. The definitions were put in the 1930s, and accordingly what we've seen is a mischaracterization of the data that's profound in the headline statistics.
Yeah, I mean, I just think back to the first time when I began reporting on financial markets, this idea of non-farm payrolls, it struck me as something kind of antiquated because people don't talk like that, in that farm payrolls are not a huge part of the U.S. economy. Gene, when you look at the data that does come out, which data points are perhaps overweighted, overrated, versus those that are underappreciated?
Well, sadly, almost every headline statistic is flawed deeply. You take unemployment. When they report 4.2%, 4.3%, that is based on whether you worked even 1 hour in the last 2 weeks. So if you worked 1 hour in the last 2 weeks, you're counted as employed. Now, that's not what we in a common sense way think of as employed. If you're living in a tent or in Washington, D.C., sometimes under bridges, but you get 1 hour's worth of work, that's not how we think of employed. So the data understates the problem. In fact, it's more like 24 to 25% of the American people are unemployed in a functional sense. That is, to be able to put good food on the table, have a roof over their head. So we have a much more profound problem for middle and low-income Americans than is typically reflected in the headline statistics.
Right.
Same is true with inflation.
Right.
I'm sorry.
No, go ahead.
No, the same is true with inflation. We use the CPI, which is a basket of 80,000 goods and services, which over the last 25 years has inflated more slowly than the basket of goods and services ordinary Americans use, which is inflated more quickly. Accordingly, middle and low-income Americans are hurting, and they've been hurting a great deal, and we've seen that more recently in the spike in inflation.
So, of course, this matters for everyday Americans, as you mentioned, but bring this conversation forward to what this also means for policymakers, not just for the Federal Reserve, but also for officials, of course, in the government trying to make policy if some of these struggles are being masked, in a sense, by the data that's being collected.
Well, that is the big takeaway here, I think. Left and right, people come to government, they try to do the right thing, and they try to do the right thing for their constituents. The problem is if you basically are misled by these statistics, you don't realize how serious a problem we have in America. If we continue to decline, and we have been declining in this country for the last 25 years in terms of middle and low income Americans, if we continue that trajectory, we're looking for social dislocation. It's a very, very serious problem indeed.
All right, Gene, it's fantastic to get some time with you today. That is Gene Ludwig. He is former U.S. Comptroller of the Currency and the author of The Mismeasurement of America and a Haverford College graduate. Now, coming up, high hopes for Tilray sending the cannabis stock soaring after earnings. It's today's Stock of the Hour, and it's up next. This is The Close on Bloomberg. Well, today's Stock of the Hour is Tilray. Shares of the cannabis company soaring after beating earnings and net sales estimates for its fiscal first quarter. Canadian adult use driving up cannabis sales, while softer demand for beverages kept a lid on that category. Joining us now to discuss is Kenneth Shea. He is senior analyst for beverages, tobacco, and cannabis over at Bloomberg Intelligence. And we were joking, of course, that we're actually not talking to you about PepsiCo, but we're talking to you about Tilray, and for good reason, because shares rising as much as 35%. But this is a company where it has extreme peaks and extreme valleys, it feels like.
It really does, you know, and part of that is just the nature of the world of cannabis, a really rough and tumble, world out there that's seen highs and lows and everything in between. I think the excitement over Tilray lately is because of some of the comments President Trump has tweeted or said, and that is they're looking into rescheduling in the U.S., referring to the Controlled Substance Act in the U.S., that could lower marijuana from Schedule 1 to 3. What does that mean? It means that it's no longer deemed to be, a drug with zero benefit like heroin and others. What it means in a practical sense, though, is that it's much more lenient to be sold in the U.S., and that companies selling it can do so in an easier way. Now, that doesn't translate necessarily to Tilray. A little complicated here, because Tilray competes outside the U.S. with cannabis. It's essentially the biggest seller in Canada and in international markets, but it's looked to ways to get into the U.S. as soon as it can, it's looking to federal legalization to do that.
Okay, so it's kind of higher just on sentiment towards this sector overall, and we also see Canopy Growth, Kronos, Curaleaf, Verano, and the ETF that tracks this group rising as well. If they were to reclassify cannabis to something less harsh, Ken, what does that mean for these companies' abilities to do banking across borders?
It's a great question. No one really knows exactly what it means. I think the way the market is perceiving this, though, if it got rescheduled to level 3, I think what Tilray believes, and many do, is that it could at least compete in the medical cannabis world. It could partner with a pharmaceutical company who needs big supplies of cannabis. Among other ways, it's looking at ways they could get in. I think from a market perspective, though, it would see rescheduling to level 3 as the first step towards full federal legalization. And that would open the gates for Tilray to do a lot of things in the U.S. that it's prepared to do.
And it was interesting. I mean, I noted this in the intro that adult Canadians are using cannabis, but not when it comes to beverages. So sort of, bring us into your world. Why necessarily aren't we seeing the pickup, the strength when it comes to that method of transportation for cannabis?
For beverages?
Yes.
Well, Beverages, up until just a couple of years ago or so, most of the cannabis-infused beverages were sold in dispensaries, in licensed dispensaries. And most of the people that go there are really looking for, cannabis buds, flowers, vapes. They don't really go for beverages. That hadn't been really a big seller. That all changed over the last year or two when a lot of producers decided to exploit the loophole in the Farm Bill that legalizes hemp. Hemp, a close cousin from a species point of view in cannabis, has traces of THC, but it can be extracted to the point where some clever producers are putting it into hemp-based THC products, which can be sold in mom-and-pop liquor stores. And so there's the opportunity there.
Ken, really appreciate you joining us and giving us your perspective. Kenneth Shea is senior analyst for beverages, tobacco, and cannabis at Bloomberg Intelligence. Cannabis beverages seems to be in opposition to the drink that is very popular, which is energy beverages.
Yeah, right? I mean, mix them together, see what happens. It could be fun.
Yeah, or nothing would happen because they cancel each other out.
That's true.
Yeah. All right, coming up, we're going to take you to the closing bell. Emily Roland, co-chief investment strategist at Manulife, John Hancock Investments, will be joining us next to talk about these markets with the S&P 500 down on the day. This is Bloomberg.
You're seeing flows coming into bond funds today, whether it's high-grade taxable or high-grade tax exempt. So I think it's really kind of looking at where investors are allocating assets as that hedge, but also being mindful of the risks that we continue to see.
And that was Alex Petrone, head of fixed income over at Rockefeller Asset Management, kicking us off to the show. A day where actually the S&P 500 is red, which it feels like we don't see that often.
Yeah, it's actually the second decline in 3 days. So it feels like there's a little bit of a trend here. Maybe people are getting exhausted with this equity rally. I mean, still very much near record highs and has had this tremendous run since early April. But you do see a decline of 0.3%. Yields are also higher across the curve. There was a $22 billion auction of 30-year bonds. Long-dated treasuries does not seem to be in favor.
Yeah.
And the demand was kind of mediocre as well. But the dollar is now maybe finding some favor, which is a real sea change from what we had been seeing. And this comes at a time when people continue to plow into precious metals. Silver's been bouncing around. It did get past $50 an ounce, which is the highest since, I think, the 1980s. Yeah. You have to go back to the Hunt brothers cornering the market.
I'm glad that we're highlighting silver because we've been spending so much time on gold that for a lot of folks, maybe silver went by unnoticed, but really a lot of excitement when it comes to metals, a lot of excitement when it comes to pretty much everything, it feels like. Let's welcome in Emily Roland. She is co-chief investment strategist over at Manulife, John Hancock Investments. Great to have you with us, Emily. And today's action, putting it aside, it does feel like we are in the midst of an everything rally. When you take a look across asset classes, specifically when you take a look, of course, at the S&P 500 in conjunction with what we're seeing in gold, with money market funds, just everything, it seems like, is going up. How long can that last?
Yeah, Katie, it's amazing. If you look back over the last 6 months, we went from some of the most deeply depressed sentiment across consumers and investors that we've seen in quite some time to this almost relentless dip buying that's been going on since the recovery began back in April. And, markets are feeling a bit extended here. We're pushing up on 23 times forward earnings on the S&P 500. Of course, the most expensive U.S. stocks have ever been is 24 times during the height of the dot-com bubble. I would say the good element, though, is that the earnings engine is on. So when you look at the denominator of the PE ratio, we've seen really solid earnings results out of the S&P 500. Analysts are penciling in 7% earnings growth for the season that starts next week, 7% for Q4. So the earnings picture looks pretty good to us. The challenge, of course, is that markets just continue to rip. It doesn't matter what you own. Everything is up. Nothing can stop this market. So I think investors need to proceed with a little bit of, caution as we head into the final quarter here.
Yeah, it's interesting. I was just having a conversation with someone this afternoon, and of course, the equity market at these nosebleed levels came up, and they made the point that earnings are better than they ever have been. Of course, you would see these all-time highs, Emily, but you also make the good point that, okay, but even still, I mean, we have just absolutely been ripping. How high is the bar of expectations heading into this next earnings season?
It's actually pretty low, Katie. I mean, 7%, we think that companies do have a good chance of overcoming that hurdle in the United States. But what I would point to is abroad. I mean, you have seen people ask me all the time about the froth in the markets. And while we may be experiencing elevated valuations in the US, look overseas. You look at things like the MSCI EFA index, which is up almost 30% year to date on 1% earnings growth. The expectations are for low single digits there for the rest of the year. Chinese stocks are up over 40% year to date on basically 0% earnings growth. So when we look at global markets on a relative basis, we're still finding the most value. I mean, I know that seems like a bit of a misnomer. There's not much that's on sale today, but we still look at high quality stocks in the United States as being the best relative opportunity based on those trends.
Yeah, you just have to do your homework to find them. Earlier on, you mentioned dip buying. Dip buying requires an actual dip, and we haven't seen that many of those dips. I wonder how much dry powder is really left. We talk about the record $7.3 trillion in money market funds, but that money has proven to be pretty sticky. People like keeping it there. They don't necessarily want to deploy that. So how much money is out there that people are waiting to put into risky assets like equities?
Yeah, I mean, you talked about that cash on the sidelines, and that's one of the biggest elephants in the room, I think, in our conversation with advisors. And I really think the key implication there is a missed opportunity to lock in income with that cash. So if you're sitting on the sidelines, I think, you can take a little bit more risk by going out on the curve, embracing a mix of high quality bonds that are yielding 4 to 5% and locking in that yield and building a return stream that can last for years. We ran a chart the other day that almost made me cry. I was wondering how long investors keep allocating to money market funds as interest rates are coming down, which is what we expect to happen here. And it's all the way until rates are zero. And then investors buy bond funds. So there's just this huge missed opportunity, in our view, of all of that cash that, again, that dry powder that's sitting on the sidelines. I'm not saying use it to go into speculative corners of the market, unprofitable retail favorites, things like that. That's where the puck is going. I think a mix of high quality stocks and bonds should make a lot of sense.
I don't want to ruin our conversation by bringing up the government shutdown, but I've noticed that we haven't talked about it yet. And I just wonder if that's an underappreciated risk right now, because we've got this everything rally. Everything seems high, and there's a lot of money sloshing around. There's a lot of expectations built into IPOs continuing to come out, a lot of deal making. Certainly some of that will be disrupted.
Yeah, and I think, you've heard the stats. There's been a lot of ink spilled on this, that this is more of a political event than a market event. We look back on the 14 government shutdowns that have occurred since 1980, and 3 months later, every time the S&P 500 is up, I think, of course, the risk to that view is that it is very, very much consensus. Still our base case, but if we do experience an extended shutdown, if anything, it increases uncertainty around the state of the U.S. economy. Not getting these jobs reports, I mean, it has opened up a little bit of free time for all of us. But, not having this data is going to be a big challenge. And it results in a lack of visibility for the Fed, a lack of visibility for investors. And I do think that could contribute to some potential downside volatility here as we contend with just a lack of information. Luckily, we do have earnings season next week.
That's true. We will get, of course, some data coming from corporate America, but it's going to be very interesting if the government doesn't reopen by October 29th, what on earth that Fed decision will look like. But Emily, I want to talk a little bit more about tech, because one of the big stories this week, other than the shutdown, of course, has been all of the deals going on in the AI space and just how interconnected they all are. When you think about the overlapping deals with OpenAI, NVIDIA, AMD, Oracle, the list goes on. And as an investor, I wonder how you approach that, the idea that a lot of these deals are circular and these fortunes of these companies are getting more closely tied together.
Yeah, Matt Miskin and I were joking this morning, like, what if we decided to sell like paper clips to OpenAI? Would our stock go up 400%? It seems like all you have to do is make an announcement in conjunction with OpenAI to see this pop. And, while we do think that the investment is real, we do think that there is a phenomenal opportunity for increased CapEx in the space. When there's this much excitement and optimism over time, we've seen examples of a misallocation of capital. And we want to be mindful of that. We want to be mindful of the froth in these areas. So we have a bit of a love-hate relationship with the US mega cap tech space, particularly names that are exposed to AI. We like the quality. We think the earnings can deliver, but there's a major issue around concentration, some of the circularity themes that you highlighted, as well as valuation risk with the S&P 500 growth index trading at almost a 50% premium to its 20-year average. So we're there. We like a lot of these names, but we're diversifying by owning things like mid-cap stocks, which have a totally different sector composition with overweights to industrials, even financials that are benefiting from M&A activity. So we want to be diversified. We want to protect against that valuation risk by owning higher quality areas that are trading at a discount.
All right, Emily, great to get some time with you. That is Emily Roland. She is co-chief investment strategist over at Manulife John Hancock Investments. Meanwhile, we're less than a minute to go until those bells ring. Here to help Scarlett and I wrap up today's market action, I'm pleased to say we have Bloomberg Opinion's Jonathan Levin as well as Bailey Lipschultz with Bloomberg News. You take a look at the board right now with 13 seconds to go. You can see a rare down day for all of your major averages right now. The S&P 500 going to finish about 0.3% lower. The NASDAQ down a little bit less than that. Dow Jones, whoever looks at that, it's down about 0.5% as well. Scarlett, even with NVIDIA higher on the day, to see markets end lower, it's pretty interesting setup here.
Yeah, and it feels rare that we see a decline, although it's the second drop in 3 days. And the S&P 500 continues the streak where it doesn't close up or down by more than 1% for this long, long stretch of period. We're kind of melting up. We're just kind of drifting off these highs. So it's really interesting to see how this all plays out. In terms of the sector performances today, decidedly negative in terms of how the groups shake out. You have only one group out of 11 finishing in the green, and that is consumer staples, up 0.6%, the ultimate safe haven there. Everything else is in the red, and the declines are led by materials, industrials, and energy. Each of those groups losing more than 1% on the day.
How about those gainers? Jonathan, do we have you?
You've got me. You've got me.
There he is.
Let's go first to a stock that is really enjoying that ChatGPT, NVIDIA halo effect. Emily Roland was just talking about this. I'm talking about UiPath. The ticker is PATH. This company is up like well over 45% since pre-market September 30th, when the agentic automation company said it was collaborating with NVIDIA and OpenAI on separate projects. The street doesn't totally understand what's going on here, I got to tell you, because nobody has a price target that's as high as where the price is right now. But we've got this thing up another 19% today, 18.8% to be exact. Moving on, I want to talk briefly about Delta. Ticker is DAL. It reported better than expected 3Q earnings and predicted continued strong demand into next year after reporting better than expected earnings for the third quarter. Under the hood, things are looking pretty decent for airlines across the board. They're saying that leisure travelers are paying up for those premium seats, and corporate travel actually coming back, looking pretty decent here. Finally, I want to talk about Pepsi. The company said it saw 2% growth in its North American beverage unit in the third quarter, best in almost 2 years. As Bloomberg's Christina Peterson reports, it's working to cut costs and overhaul its portfolio to meet some shifting consumer tastes. All in all, stock ends up 4.2% on the day.
Yeah, let's look at some of the decliners, though. And I want to start, Jonathan, with one of my favorites, Ferrari. The ticker is RACE. Stock down 15%, guys. Worst day since it went public back in 2015. We're talking about 2030 EBIT guidance lowered because of expectations related to their electric vehicle rollout. So a bad day for the luxury car maker. Another bad day for a different sector, which was gold miners. So I want to call out Newmont down. The most since July, down 3.6%. This comes after a pullback in gold. So all the gold bugs who have been pounding the table that gold is going to the moon. It has been, but maybe a bit of a breather today. And then also want to wrap up with Helen of Troy. You guys may say, why are we talking about a company worth less than $500 million? Well, they make OXO products. They make Hydro Flask. So they did talk down their full year expectations, really calling out weakness in some of their consumer goods. So that stock, ticker HELE, down 25%, worst day since 2024. But again, it seems like maybe people aren't paying up or going to buy new water bottles and some of those home
Why
goods.
do that when you can go to TJ Maxx and buy it on sale? But Helen of Troy, by the way, one of the most shorted stocks as well. About 14.7% of their shares are shorted.
Wow.
Along with Applied Digital, which will be reporting earnings any minute now.
Yeah, shorts having a field day, at least when it comes to Helen of Troy. We'll see what happens with Applied Digital. But let's take a quick look at yields right now. Pretty well behaved across the curve, even on a sell-off sort of day. You can see that a lot of the pain was felt in the 5-year and the 10-year tenor, that part of the curve. We did have a 30-year auction, and you did see a concession built into the curve ahead of that. It actually came out pretty okay when it comes to demand, pretty solid. Primary dealers who are expected to bid at the auctions actually took a record low share, but that wasn't enough to reverse the trend that you're seeing across the curve right now. A bit of a sell-off in yields, no safe haven bid here, guys, which I find interesting, even though, of course, you did have one of those rare down days in the market, Scarlett.
Safe haven, what's that? I mean, right now, everything is a safe haven. If you look at Bitcoin, if you look at gold, if you look at treasuries to a lesser extent, but they're your traditional safe haven. Silver has become the safe haven of choice as well. Today, bouncing around all over the place. Bailey, when you are reporting on the market, what are you hearing from people in terms of where they find safety, where they find risk?
It really depends who you're talking to. When we look at a day where we saw major averages pull back and quantum computing stocks are rallying, there's definitely appetite for going risk on. But to the point you made about Helen of Troy, a lot of those stocks are heavily shorted. So investors are really kind of picking their spots. Again, when you see, or you're actually in an environment like right now where, call it a information vacuum, if you will, while we wait for those big bank earnings to really truly kick off earnings season. That's what I'm focused on, and that's what people are focusing on. Jonathan, I don't know if Delta earnings kind of gave you a view into the consumer or into the business world, but it does seem like at least earnings so far maybe have been positive from there.
Yeah, well, I'll tell you one thing about Delta. The consumer is certainly not collapsing, and I've been hearing that story for about 3 years running now. But, you know, we've got leisure travel popping. We've got corporate travel coming back. Doesn't seem too terrible, to be honest.
Well, I have some good news. We have even more earnings to dig into right now. This coming from Applied Digital, as we teased. It looks like when it comes to their first quarter revenue, it actually beat expectations. First quarter revenue for Applied Digital coming in at $64.2 million. The estimate had been for $46.1 million. So a big beat there. Then you take a look at the first quarter adjusted loss per share coming in at 3 cents. The expectation had been for a loss per share of 13 cents. But even still, you can see shares down about 2.5%. But I have to say that expectations were pretty high for this name, Scarlett. Year to date, heading into today's close, they were up about almost 250%. So the bar was certainly high.
Yeah, also one of the most shorted stocks, so worth remembering there, keeping an eye on those declines. Another company that has just reported is Aritzia. It's the Canadian specialty apparel retailer, and it's coming in with adjusted earnings per share 59 Canadian cents for the second quarter. Analysts were looking for 39 cents, so a beat there of 20 cents. Net revenue of $812 million, also higher than what was anticipated, $752 million. My own arbitrage, Katie, recently when I was in Canada was to go buy clothes at Aritzia using my strong dollar, relatively speaking, to the loonie, and I got some clothes.
Yeah, there you go. All right, so a check on the consumer, of course, from our own Scarlett Fu. It is going to be interesting. I mean, we always care about earnings, you guys, but as we have raised, the fact that you are in this data vacuum when it comes to the government data, we're not going to get those check-ins when it comes, of course, to consumer sales, when it comes to retail sales, when it comes to inflation. So, I mean, the question is out there, Jonathan, whether or not we take even more of a closer look at these corporate earnings as a lens to view how the economy is actually humming along.
Yeah, absolutely. It's going to be that. It's going to be some of that alternative data, which, I've said a number of times is imperfect in many ways. I'd love to have the government data as well, but you make do with what you have. But, look, it's going to be an interesting earnings season here. This is not sort of your typical earnings season where we're expecting kind of the Mag 7 to do all of the heavy lifting. I think it'll be interesting. The street's expectation is that industrials are going to come in here with a little bit of earnings strength. So it'll be great to really peel back the onion and see what's going on a sector by sector basis.
All right, well, those big banks are coming up, so buckle your seatbelts. Guys, great conversation. That is Jonathan Levin of Bloomberg Opinion, as well as Bailey Lipschultz of let me say that right, of Bloomberg News, and Scarlett, who is wrapping up her day on TV, really burning the midnight oil, so we appreciate that as well. Now, coming up, a discussion on OpenAI's dominance as a private company in the public markets. We'll have that with Gil Luria. He is D.A. Davidson & Co. Managing Director and Head of Technology Research. That conversation up next. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld. Let's take a look at where markets closed out on the day. The S&P 500 down for a second day in 3, off by about 0.3%. Not much of a decline, and I'll note, of course, we're close to record highs, but you saw a similar story play out when it came to the NASDAQ 100. Big tech also taking a little bit of a leg lower. That did not send a haven bid into bonds. You can see the 10-year Treasury yields rose by about 2 basis points, even though that 30-year sale went over not too bad. And then gold. Actually, this is interesting. Gold back below $4,000, but a lot of folks saying that there's more room to run and it's a matter of time before we cross that benchmark once again. Let's take a look at some of the individual names on the day. We're in earnings season, even though we're waiting for the big banks to officially say so. We got earnings from Pepsi and Delta, both going over better than expected, beating estimates. You can see that both of those companies rose by more than 4%. I wanted to highlight NVIDIA as well. No real news here, but NVIDIA shares up almost 2%. Interestingly, you still had the indexes fall on the day, so not even a rally in NVIDIA could actually bring us into the green on the benchmark level today. But our top story this hour has to do with NVIDIA, and it has to do with AI deals, raising fears of a new tech bubble that could be inflating rate as we speak. OpenAI alone has now struck AI computing deals with NVIDIA, AMD, and Oracle that altogether could easily top $1 trillion. As such, concerns escalating right now that an increasingly complex and interconnected web of business transactions is artificially propping up the AI boom. And our next guest says that there is a very real element of growth in AI, but side by side, there are bubblicious elements as well. His name is Gil Luria, the head of technology research at D.A. Davidson. He joins us now. And Gil, I'll just ask the question that everyone is asking me. Is this a bubble?
Yes, there are bubble elements. And again, there's a really big part of this that is very real. The technology and the capabilities of AI are tremendous. Even if all the technology stopped today and we were just able to use what we have now, it would transform our economy. And we're not stopping. We're continuing to develop the technology. We're all using it in our personal lives. The tools are getting better. There is real increasing demand in compute. And there's a real part of it, which is mostly the companies that we know and love. Microsoft, Amazon, Google, Meta. All these companies have all the customers that want to use AI, that are booking capacity a year in advance. And that's real. And they all need NVIDIA chips, and that's real. The bubblicious part, and thank you for letting me say that word on the air,
of course,
is what NVIDIA and OpenAI are doing to make it seem even bigger than it is. NVIDIA is seeding its own customers, a whole new set of customers to compete with those existing customers in order to diversify its business, which is fine. We just need to be aware of that. And OpenAI knows that it has to compete with these enormous companies that are orders of magnitude bigger. And for that, they're playing the traditional Silicon Valley game of fake it till you make it. They are making all these promises across the board that there's no possible way they could live up to in order to look bigger than they are so they can continue to compete with those much bigger customers. So there's a real part and there is a bubblicious part.
Well, to your latter point on OpenAI, fake it till you make it, that sort of ethos here, I think that's the part that gets people a little bit worried here, because you think about the fundamentals of OpenAI, it's burning through cash right now. It doesn't actually expect to be cash flow positive until near the end of this decade. So I know that markets are forward pricing mechanisms. So it feels almost like the hope here, Gil, is that, okay, maybe it doesn't make this money right now, can't fulfill these commitments right now, but it will be able to in the future. As someone, who analyzes companies day in and day out for a living, how much water can you put in that theory, to mix metaphors?
Right. So there's a chance they'll be successful, and so far they have been. And just for those not familiar with the term fake it till you make it, Bill Gates walked into an IBM conference room in the late 70s and sold them the very first operating system, DOS, without having even met the person that invented and owned DOS. And yet he built the biggest company, still the biggest company in all of technology that way. So fake it till you make it is something that has built Silicon Valley. And right now, OpenAI is looking like they may actually pull this off. But it is very risky. And we have to acknowledge that OpenAI has made somewhere between $500 billion and $1 trillion worth of commitments. It still only has 15 billion of annualized revenue run rate, and is losing as much as 10 billion a year. It's expecting to lose 70 billion over the next few years. So it will not have the cash flow to fill those obligations. It is counting on the capital markets to help fund this enormous build out so they can pay for these obligations. But that means hundreds of billions of dollars over the next few years of debt financing that's going to have to come in. It's possible that they'll pull it off. So far, so good. But it is also very risky. And there's a handful of companies now that are dependent on OpenAI promises and on OpenAI magic. First and foremost, CoreWeave, that's all OpenAI. Oracle, a third OpenAI. Oklo is all OpenAI expectations. You haven't mentioned earlier in the hour UiPath, that just by putting out a press release about talking to OpenAI, got 20% tacked to its stock. That part is artificial.
Yeah, so there's so much to dig into here, especially when it comes to the fact that you are having a lot of these big tech names, Oracle, chief among them, tapping the debt markets now, what that means for technology and the capital markets there. But we should probably focus in on that latter point that you made, that it feels like the fortunes of these companies are becoming more interconnected when you have these overlapping deals. And Gil, I feel like that's another area where you could start to get a little bit nervous. If one chip falls for one company, what does that mean for the rest of the stack?
That's right. So I'll be careful in bringing up the next example. Enron, back in the day, created special purpose vehicles that it had some equity in, but borrowed money in order to turn around and buy its services. That would have been legal and okay had they disclosed it. They didn't disclose it. So the behavior we're seeing now from these large companies is very similar. They're putting these off-balance sheet special purpose vehicles out there to take in the assets, take on the liabilities, and those companies are purchasing services from them, and that's not real. And we have to remind ourselves that that part is not real. It could lead to something real down the line, but it's not real demand. Real demand is when an actual customer that wants to use the product is buying from you without you having to invest in them, and certainly without you having to borrow money in order for that customer to pay. That's where we really need to be careful. And again, NVIDIA and OpenAI are engaging in this in a very significant way, and that it serves NVIDIA's purposes. They want to diversify away from customers. It serves OpenAI's purposes. They want a lot of people to have skin in the game. Part of the way they make that leap into becoming a mega cap, the part of the way they fake it till they make it, is by convincing a lot of these big companies that OpenAI has to be successful and to continue to invest there. But if that doesn't work, there will be a lot of shareholders and a lot of debt holders that are left holding the bag and will own nothing but significantly depreciated GPUs. That's what we need to be careful of.
All right, Gil, unfortunately, we have to leave it there. And we should note, of course, we haven't independently verified some of those claims that you raised there. But, of course, this is a story that we will be closely following. Gil, really appreciate your time. That is Gil Luria. He is head of technology research over at D.A. Davidson, talking about, of course, these interconnected deals underway when it comes to the AI sector. But let's talk about jeans. We have some earnings out from Levi Strauss. This is an interesting reaction because actually their third quarter adjusted EPS, it beat estimates. Full year adjusted EPS in particular came in at $1.27 to $1.32. That is their expectation. Their previous range had been for $1.25 to $1.30. So raising the bar there when it comes to guidance, also beating on third quarter adjusted EPS at 34 cents versus the estimate of 31 cents. But you can see that the reaction sharply negative right now. Levi Strauss down about 5%. This is the close on Bloomberg. Well, the Argentine peso gaining as the U.S. steps in, finalizing a $20 billion currency swap framework, with Treasury Secretary Scott Bessent adding that the U.S. Treasury intervened in the FX market as well. Joining me now is Bloomberg's Mike McKee, who, of course, has covered previous U.S. FX interventions, as well as Julia Leach, who covers emerging markets for us, both joining me at the desk. And Julia, I'll start with you because we've been on watch here for a few days. Now we get the confirmation that the U.S. is coming in, intervening in these markets. What do we know so far?
So we know what Bessent tweeted, right? That they finalized talks for this $20 billion swap line, which the Argentine economic team has been in D.C. for a few days discussing. I think they flew in Friday. And he also made this, I think, a bit surprising and extraordinary step to say we stepped into currency markets and bought pesos directly, which I think caught everyone a little bit by surprise.
Yeah, absolutely. And you can see the reaction in those markets right now. But we know that when it comes to FX intervention, particularly unilateral FX intervention, as you pointed out in the break, it has a mixed history of success. So even though we're seeing this knee-jerk reaction now, Mike, there's no guarantee that this will stick.
Well, the U.S. has only done this 3 times before. Once was 1998 when they bought yen, and in 2000 they bought euros to try to strengthen both of those currencies. But they did it in concert with other G7 countries. And then in 2011, the U.S. and other G7 countries sold yen after the Japanese earthquake. And that was less an intervention for manipulating the currency than it was to make sure that the Japanese economy stayed on a level basis. But the Japanese have been the people who intervene all the time on their own. And it worked for a while in the 1990s, but it just got to be almost impossible to do because the amount you can buy in a currency market that trades $9 trillion of currency a day is so small that unless you get the markets believing that the currency is going to go in the direction you want, you basically spent money for a few days worth of reaction. Yeah,
it's like throwing pennies into the ocean. But to that point, Julia, I mean, how committed is the U.S. here? Because you think about the Argentinian side of things, the Argentine Treasury has all but drained its reserves at this point. So, I mean, is it in for a penny, in for a pound for the U.S.?
That's a great question. And I think we have been seeing for the past, 3 weeks, a month, which is when Argentina's markets started going off track. Every show of support, be it a tweet, be it a Trump comment in favor of Milei, it does move the local market, particularly on the bonds, because there is this expectation like, oh, the U.S. can come in and stop me out of this bearish trade, right? So there is a willingness of markets to test it. And I think today we saw the first real show of we actually did come in and there's something behind just what we've been saying. So it could give us a little bit more stability until the elections, the midterm elections on October 26, which are really key here for the next, 2 years of Argentina and Milei's government.
There is a little bit of a background to this in that in 1994, Mexican peso crisis, when Mexico couldn't roll over its bonds because the peso had lost so much value, and the Treasury Secretary then Bob Rubin wasn't Treasury Secretary yet, but he arranged it as the National Economic Council director. They guaranteed Mexican debt.
Right.
And they used the money from the Exchange Stabilization Fund as they did this time. They didn't directly buy pesos, but they stabilized the debt, and Mexico paid all the money back. It'll be interesting to see, to the extent we have a swap line use, that whether that money comes back or not.
Yeah, we were actually just having that conversation with Gene Ludwig, the former U.S. Comptroller of the currency, and he was reflecting on that Mexican crisis back in the day. So we'll see, of course, how this goes over. Our thanks, of course, to Bloomberg's Mike McKee and Julia Leach. Now, still ahead, we're speaking with Partners Group CEO David Layton about the private markets and increasing access. That conversation next.
You're seeing a convergence of public and private markets, for sure. I think there's some experimentation going on, but the key here is that we've always stood for the past 15 years, a responsible democratization of alternatives. We want it to be done the right way. We think it's in the best interest of investors to have exposure of private markets, but it can't be done in a way where, say, we're trying to gamify structure for distribution purposes.
And that was KCEO Matt Brown speaking with us yesterday about how there's growing interest in private markets, and that's reshaping the industry. Our next guest has been pushing to broaden investors' access to private markets through institutional partnerships and reworking key regulatory frameworks. Joining us now, I'm pleased to say, is David Layton. He is the CEO of Partners Group. Great to see you on set.
It's a pleasure to be here. Thanks for having me.
Let's start with the partnerships, because I know you recently signed one with PGIM. You have a partnership as well with BlackRock.
Yep.
And I do think it's interesting that you have this growing trend of you have these more traditional asset managers signing on with private market specialists. And I wonder why that is happening and why that needs to happen.
Well, I think if you look back over the last decade or so, we've all been quite happy to ride the markets as these large technology positions have been built. But now that they're built, we have to live with the volatility associated with that. And so you have investors increasingly that are looking for ways to diversify their portfolio. And over the last 30 years, the private markets has become home to many of the world's most interesting middle-sized companies. You know, people used to invest into the Russell 2000 and things like that to get their mid-cap exposure. If you look at the number of companies that have been going public the last number of years, it has been a small fraction of the number that have been acquired by private markets firms like us. And so the way that investors get access to the most interesting middle-sized companies today is through private markets portfolios. And so you're starting to see the portfolios of the future coming together as a blend of public content and private content. And I think that's a trend that's going to continue well into the future.
It's a good point that for a lot of investors, it's not two separate conversations, public or private, that increasingly it's the same conversation. But to bring it back to the partnerships, I mean, what do you bring to a PGIM, to a BlackRock, even that they couldn't just build in-house at this point?
Yeah, so with all of this interest coming into the evergreen space in particular, a tool used to make private markets content more accessible to everyday investors, Partners Group has been one of the leaders in that space. We have almost a 20-year track record now of building and managing evergreen structures, bringing private markets content to individual investors. And that's a big part of what these partnerships are based on, that long-term track record of success. We now have $52 billion in evergreens. And so for partners that have some scale ambition within the space, having a partner that already has some critical mass built within the topic is helpful.
Let's talk a little bit about where this could go when it comes to broadening access, because wealth channels are one thing, you know, increasing access to everyday investors, that's one thing. I feel like that is a slightly different conversation than when you're talking about retirement and putting private assets in 401ks. And I mean, What is the pitch there when it comes to 401ks? Why do we necessarily need to have private credit or private companies in your retirement savings?
Yeah, and there have been some early movers in that space. So with Empower, they're one of the first, providers in the 401k space to announce that they'll be putting private markets content in that, and we're one of the partners that they've selected to do that with. And it comes back to that same topic that we talked about previously. It used to be when people thought about the public markets, well, that's where you go to get your, exposure to large companies that anchor the economy, household names. And the private markets used to be more speculative in nature, risky venture capital or highly leveraged equity. But that dynamic has changed. There's much more speculative activity taking place in the public markets today. And the private markets has expanded to be a $15 trillion asset class that is home to many entire sectors and subsectors that are now serviced by this large asset class. And so as you think about the portfolios of the future, you need to blend together private content and public content in a format that is digestible. And I don't think anybody's anticipating that people are going to go into their 401ks and rebalance into a private markets fund directly. But there are parts of these 401k programs that are professionally managed. And as part of a broader portfolio strategy within those segments of the portfolios, I think private markets makes a lot of sense.
Something else that I think about a lot is the way that people are actually accessing private markets, what fund structures they're using to get there. I cover ETFs very closely, and that's been one of the most fun thought exercises of the past several years is how do you fit private companies, how do you fit private credit into ETFs? And there's a lot of hand-wringing over whether that's appropriate. When you think about the liquidity mismatch between a truly private asset and an ETF, which of course trades all day long. And I wonder where you fall in that debate.
Yeah, I think when people think about private markets, you need to think about that as a long-term investment into the space because in order to trade in and out of the sector, you have to use tools like the secondary market. And that market is growing. That's grown from a $50 billion market a couple of years ago. It's probably $100 billion of opportunities that have been capitalized in the secondary market so far this year. So that is a growing part of the market, but you can't rely on that. I think when people think about private markets, this should be the place that you go to invest into good, solid businesses for the long term. And there are things that we can do to make those structures more liquid, more easy to use. The tools that we've used historically, limited partnerships, these are archaic structures that are not really meant to allow investors to rebalance their portfolios and to make pivots mid-cycle. And the tools that we're building today, these evergreen structures, are meant to be long-term investment vehicles, but do give investors a reasonable amount of ability to rebalance those portfolios. And so from our perspective, you can make it more liquid, but it's always got to be thought of as a long-term investment.
All right, Dave, great to get some time with you. Really appreciate you coming to studio. That is David Layton. He is CEO of the Partners Group. This is Bloomberg.
I think what has happened over the last 3 weeks, I think was very unfair to my bosses at Disney. I don't think anyone should ever be put in a position like this. It is insane. And I hope that we drew a really bold red line as Americans about what we will and will not accept. I mean, I really hope that that's what comes out of all of this.
And that was Jimmy Kimmel speaking at Bloomberg Screen Time following his controversial suspension by ABC. Also taking the stage in LA, we had Paramount Skydance CEO David Ellison. He spoke with Lucas Shaw about the company's strong TV lineup and content library. Let's take a listen.
You need to distinguish when you talk about the linear business, right? There's cable, which yes has been in decline. But if you look at CBS, it actually is a remarkable asset that's been #1 in primetime for 17 straight seasons, incredible sports rights, which we're growing, and is still highly profitable from a cash flow perspective. And I agree with you, has not been run in the best manner for the last 15 years. And for me, that's all opportunity. An opportunity to really reignite the creative content engines, to navigate the transition that's required to really turn Paramount Plus into a leader in streaming. And we believe we have the ability to both win in content and also become the most technologically capable media company to effectively navigate this transition. We always looked at, you can look at the music business 10 years ago. We believe we can navigate that. We also really looked at where traditional tech companies were, call it 10, 15 years ago. And there was a period of time where, the Microsofts of the world, the Oracles of the world were being disrupted. And those companies that actually disrupted themselves in transitions are now all trading at all-time highs. We believe we have the opportunity to do the same thing.
So you talked about streaming. You mentioned the 80 million subscribers earlier. You look at it, those monthly Nielsen reports that people pay a lot of attention to, right? YouTube's at 13% of TV viewing. Netflix is at between 8 and 9 most months. Paramount, when you combine Paramount Plus and Pluto, it sort of sits around 2%. You can correct me if I'm off there, but I think that's about right. So how do you get that up? Forget about 13 or 8, like Disney's in the 4 or 5 range. How do you get that up there? And you've talked about content and tech. Can you get specific on those fronts, like what you're going to do?
Absolutely. So look, one of the things we really believed in, look, what I'll say, we're 9 weeks in, and I'm really proud of the momentum the team has been able to build over the last 9 weeks. One of the things we really believe, being the first owned and operated studio, to my knowledge, since actually Walt Disney built his own shop, was that we would have the opportunity to really think long-term. That means long-term partnerships with talent, where you can basically say, don't just think about your next movie or your next show. We want to build a relationship with you over a decade and actually say, we're going to make your next 4 or 5 movies, your next 4 or 5 series, and really think long-term and invest for long-term growth. The great news, when you look at, we had to win in content. I think we're well on our way to being able to do that. If you look at specifics, right? We were able to get obviously the UFC deal is one of the first things we announced when we came over. We are incredibly proud that Activision chose to partner with us on Call of Duty, which is the most successful video game franchise of all time with 500 million units sold. We're able to have James Mangold come over and obviously call his, is one of the greatest filmmakers working, to call Paramount home. Boulder Light, who obviously had incredible hits like Weapons earlier this year. In addition to that, we've been able to secure high-profile packages for, with streaming with basically Paramount Plus. And then we're also really reinvigorating what we're doing in news with CBS News with the acquisition of the Free Press. And then I think when you look at CBS's broadcast lineup, I think we have the strongest lineup, maybe arguably in the company's history. And so I think we've really successfully reinvigorated the creative content engines of the company in a really short period of time. And I think we're going to be able to do that at scale.
And that was David Ellison, Paramount Skydance CEO, speaking at Bloomberg Screen Time. Let's keep this conversation on media and entertainment going with Richard Gelfond. He is the CEO of Imax. Imax, of course, just delivered their highest grossing third quarter ever at the global box office with $367 million. Richard, great to see you in person.
Nice to see you, too.
So the third quarter was great. Really, the whole of 2025 has been incredibly strong for Imax. So that sets up the natural next question, which is, how do you keep the momentum going next year?
Well, we have a very different programming philosophy than exhibitors. So what we do is we have a mix of Hollywood titles, local language titles, alternative content, sports, music concerts. So I think you'll find this interesting. In the third quarter, the North American box office was down by about 20% from last year. At IMAX, our box office was up 40% from last year. So we're just in a different business, and it's because we program so many things and we use our platform to deliver these global experiences, which nobody else is doing.
So I hear what you're saying, and obviously you have a big competitive advantage here. If you're, of course, swimming against the tide, your box office numbers are going up while everyone else is going down. But just the industry-wide perspective there, does that worry you on a broader level, that it seems like people are leaving the house less to go to the movies?
No, because I think performance is a period of time. And I think you look at the fourth quarter of this year, and obviously you have Avatar at the end of the year, which Avatar 1 and 2 are the biggest movies of all time. We have Zootopia, Wicked 2, Predator, Running Man, and that's just in the next few months. And then 26 is really a strong slate. You have Odyssey, Chris Nolan's new movie. You have Dune 2. You have Avengers. You have Mandalorian. So I think there's a lot of really good content coming. The industry, obviously, over the last couple of years, because of the strikes and because of the pandemic, was thrown off course. But I think overall, the industry is going to find more of its way, but especially Imax, as we showed this quarter and this year.
Well, on a personal note, I am very excited for Wicked 2. But to get back to the growth and the growth that you're seeing and the growth that you hope to continue to see, which markets in particular are you expecting will fuel that expansion?
I think this year and going into next year, it's going to be pretty broad because franchises like Avatar are global. When you look at Zootopia, I don't know if you know this, but Shanghai Disneyland, that's the #1 attraction.
I did not know that.
See, you learned something today.
There you go.
And like when you look at Odyssey next year, that's obviously a global kind of story. Dune is a global story. So I think it's going to be the global box office more than any area. For us, our big areas of growth the last few years in terms of theater growth have been Japan, Australia, the Middle East, believe it or not, North America, even though it's a fairly mature market, Western Europe. So I think it's going to be a global phenomenon.
And when you think about, why you are seeing this expansion, even as your industry overall still seems like it's trying to get back to its pre-pandemic self, you know that the buzziest filmmakers, as you know very well, are really psyched about IMAX technology. And I wonder how you maintain that competitive moat that you have and how you stay, of course, the leader here.
Well, it's very cultural. So it's like we never think about where we were, we always think about where we're going. So we just had our management meetings this week in New York, and almost all the sessions were how are we going to evolve the technology, how are we going to evolve the brand, where are we going to take the content. We just announced today in China that we're doing the League of Legends. I think it's quarterfinals, semifinals, and the finals. And last year we sold out 160 theaters. We're opening it more broadly this year. So I think it's the way you think about yourself. So traditional exhibitors would say, well, here's the slate. We're playing it. We're always thinking technically how we could evolve, content how we could evolve, and how we could find new audiences.
So it's interesting to hear, of course, that investing in technology is front and center, it sounds like, for you. I will note that earlier this year, you did raise your buyback authorization. So how should investors be thinking about how you are prioritizing your capital allocation?
Well, a lot of our capital allocation is going to new theaters. So we have a bunch of models, but one of our ones that's working well is we'll invest. Like this year, we signed a big deal with AMC, another one with Cineworld, internationally with Canopolis. So we use our capital to help offset some of the costs, and we take a bigger piece of the box office. So a lot of people might not know the model, but we get upfront payments, and then we get a piece of the box office, some from the studios globally, and some from the exhibitors. So since the business is cranking so well, we'd like to reinvest as much as we can in the business. I was thinking of, obviously, we're in a totally different zip code, but I was thinking the way NVIDIA is using their capital to try and build demand in different places, and I think that's a model that works for a lot of companies, including ours.
Yeah, you can extrapolate across industries, from chip makers, of course, to IMAX. But to your point, I mean, you're in a very strong position right now. You take a look just at the share performance, up 65% on a total return basis over the past year. Where else could you invest right now? Would you ever think about doing an acquisition or something along those lines?
You know, I think we have so much runway in the business we're in. That's not a place we would likely go. And also, we're a little bit of a unicorn. There's not an obvious acquisition candidate. But I think we're just going to think of ways to use capital to grow. So whether it's investing in documentaries, which we do on the content side, or kind of greasing the wheels on international expansion, marketing. You probably notice if you drive around New York or LA, IMAX everywhere. So,
hard to miss.
Yeah, it is hard to. Thank you. I'm glad you saw it that way. But that's more the way we think about our capital.
Right. Richard, really great to get some time with you. We really appreciate you stopping by the studio. That is Richard Gelfond. He is the CEO of IMAX. And for more coverage of Hollywood on Bloomberg Television, be sure to watch a brand new episode of Chief Future Officer featuring Imax CFO Natasha Fernandez. Tune in next Wednesday at 9:30 p.m. New York time. This is Bloomberg. And we do want to bring you some breaking political news this hour. The New York Attorney General Letitia James is being indicted by the Department of Justice. That is according to multiple reports. Joining us now to discuss the significance is Bloomberg Law's Keith Alexander. Keith, what do we know so far about this indictment?
Well, what happened earlier today was New York Attorney General, as you say, Letitia James, was charged here in Virginia of committing mortgage fraud when she purchased a property right here in Virginia in 2023. Now, what's interesting is that this is now the second of President Trump's political foes to be charged here in Virginia with his indictment. As you all know, a couple of weeks ago, former FBI Director James Comey was also charged here in Virginia.
Right. Well, to that point, Keith, you line up those two indictments. And what sense do we have of the broader motivation here and whether or not this is politically motivated?
That's a great question. What jumps out that the reporters who've been covering this is that the new Virginia Attorney General, who was appointed just recently by Trump, she was the one who presented the case to a grand jury. That tells people that maybe the prosecutors in this office may not have been comfortable with the evidence, so they had to put her in charge of presenting the evidence to a grand jury to try to secure a charge.
All right, Keith, really appreciate you stopping by on this breaking news. That is Bloomberg Law's Keith Alexander. We will continue to follow that story, but let's set you up for what to watch over the next 24 hours. At 5 a.m. Eastern, we get the announcement of the 2025 Nobel Peace Prize. We'll, of course, watch that closely. 10 a.m., we're not getting government data, but we do get some data from the University of Michigan in the form of sentiment figures, of course, front and center as we try to cobble together a picture of this economy and also how consumers that populate it actually feel about things right now. And we do have some Fed speak to look forward to from the likes of Goolsbee and Musalem. It'll be interesting to see what they have to say as this shutdown continues. We're in day 9 right now. Tomorrow is day 10, and there's not a lot of movement on either side. Let's take a quick peek at how markets closed on the day. You can see it was a down day overall in the markets, from stocks to bonds. The S&P 500 down by about 0.3%. The Nasdaq 100 not too far behind, not sending much of a safety bid into the Treasury market, with 10-year Treasury yields higher by about 2 basis points. Gold, too, not seeing any love today, down about 1.7%, cooling its record-breaking run. Now that does it for the close. Balance of Power is up next. Have a great evening. This is Bloomberg.